Okay, so with us today to give an update on the current status in markets is Chris Watling, founder and senior economist of Longview Economics. Welcome, Chris.
Hi, Stefan. Lovely to be with you.
Good. I'm thinking we're gonna have a brief sort of review of what has happened over the summer, and then a short outlook on what to expect for the second half. You recently, or not recently, in the beginning of the summer, you went tactically underweight, and you sort of reiterated that stance now going into August. What's your view on the current status in markets, Chris?
Yeah, that's right. Yeah, we're sort of our tactical views when we're looking at a few months suggest to us that this market was due to give back some of its gains. It's obviously been very strong in the US, in the S&P 500 throughout the first half of the year. I mean, it's not the same in other parts of the world. I think other parts of the world really did well in January into February and then haven't done much at all since then. So you've had a market that's been dominated by the S&P 500 globally, the main US index, and it's been within that. It's been dominated by really 5, 6, 7 stocks. You know, the sort of magnificent seven, as they call them, the likes of Nvidia and Apple and stocks like that, and they've driven this market higher. Beyond, to be honest, where we expected, but delivered a very good first half for US equities. And as we got into June, July, early August, it looked to us that things were starting to get overcooked. You can look at positioning in markets. People were very bearish back end of last year. By the middle of this year, they've become much more bearish. You could look at things like retail sentiment, which was very bearish as we started the year and is now collectively bullish, which is a good contrarian indicator. Or you can listen to the narrative. There's a lot of chat out there that AI stocks are going to drive this market much, much higher. They're going to move into a bubble and so on. And so for us, it seemed overextended. That's what our models were saying. The narrative was very strongly positive, and there were some macro question marks about the outlook for this market. So for all those reasons, we started moving tactically underweight, and the market started topping out back end of July, beginning of August, and we've seen some pretty serious downside in parts of the market across the globe since then. So that's where we're at, and we're cautious on these markets over the next sort of few weeks, few months. We'll see how things evolve and how models evolve and how the macro dialogue evolves. And it's also worth mentioning that China is a very big concern out there for market participants that's not getting enough focus. You just look at what Country Garden is doing in China. Country Garden is the second biggest home building stock in China. The biggest went bust a couple of years ago, and the second biggest now looks like it's going bust as well. So there's some big issues with deflation in China, big issues with the home building sector, the housing market, and all of that needs to be closely watched, because what happens in China often gets exported to the rest of the world.
Yeah. If we look on we're still in the second quarter earnings season, so we have a lot of retailers this week, which will be interesting. But so far, I think the aggregate or average earnings decline for Q2 is about 6%. Still, there's a high beat ratio because expectations have come down quite dramatically over the first couple of quarters of the year. But we're in the third quarter in a row with significant decline in earnings. What has the impact been on the overall valuation of the market, would you say?
Yeah, I mean, the market is expensive. I mean, if you just take particularly the US market, I mean, other markets are priced differently, but if you look at take a straightforward PE ratio on the forward earnings of the S&P 500, it's trading over 19 times the next 12 months expected consensus earnings. And if you look at the last 50 years, the S&P really only ever goes above that when it's in a bubble. So it did it in the TMT bubble, and it did it in 2021 and 2022 during the pandemic bubble. But otherwise, the average PE ratio is sort of 15, and that includes two bubbles. So really, the average ratio is probably 13 or 14. So it's a very expensive market in the States. In contrast, if you look in Europe, it's extremely cheap, which I think is really interesting, because one relative to the other is at an extreme. Europe extremely cheap relative to the States, which is very different from the TMT bubble when we last had, the mega cap tech stocks dominating the market in 99, 2000. At that stage, Europe looked expensive relative to the US because we had the Deutsche Telecoms and the Spanish mobile phone companies. I forget exactly what it's called, the Vodafones, all caught up in that TMT bubble. And so the markets were quite expensive in Europe then. But this time, they're not at all. They're cheap on a relative basis, and they're extremely cheap. So yeah, US is very expensive, and everything else is probably reasonably priced or cheap, basically.
Yeah. If we look a little bit about what has enable this performance in the US, we talked a little bit about the AI bubble, and it seems to me that after the second quarter results started to come in, at least there's some issues for companies. I mean, they don't really. Most of the companies have struggled to incorporate any sort of AI-driven growth in their forecasts. So it seems like there's a gap between the expectations and what the corporates are seeing. We have Nvidia on the 23rd of August, so that will be interesting. Of course, they had a blowout quarter most recently, but that stock has rolled over and is down 15%, and it's all-time high in mid-July. What do you expect?
Yeah, well, we'll see with Nvidia, because, like you say, expectations are now much more enthusiastic than they were a quarter ago. And I think what we've seen with the likes of Apple and some of these big cap tech stocks is, yes, AI is great, but it's not going to change the world for a while in terms of their earnings. It's going to grow fast, but it's growing fast as a very small piece of the pie. So, I thought Apple's earnings were very interesting earlier this month. They sort of, delivered what was expected, but the outlook was disappointing, and the stock sold off sharply and gapped down and broke its uptrend line, which I thought was fascinating. And now it's broken its 50-day moving average as well. So it's like Nvidia, it's rolled over and it's come down pretty hard. The Philly SOX, which has got all the semiconductor stocks in it, including Nvidia, is down 9% month to date. So there's some big movements. The Philly SOX is on a big level at the moment, so it'll be very interesting. Like Nvidia, it'll be very interesting to see how it plays out. But yeah, I think a lot of the mega cap tech stocks are starting to look, technically from a price action perspective, a little bit weak. And it looks to me like leadership is starting to change in the stock market. And normally leadership changes when the stock market sells off. So it's going to be an interesting few days, I think.
Yeah. Could we close off with a little bit? I mean, another headwind for these lofty valuation of many tech stocks should be the rise in the 10-year yield, and the rate environment is. I mean, it's established itself on a completely different level than it was a year ago.
Yeah, that's right. 10-year bond yields have backed up from where they were a few months ago. They're sort of back towards their highs from October last year. They're up a long, long way from where they were 18 months, 2 years ago. I mean, remember in August 2020, US 10-year bond yields were trading at 55 basis points. They're now trading at 4% and change, basically. So that matters because, as we discussed beforehand, the S&P's earnings yield is about 5%. Bonds are offering the same sort of return, and they're the risk-free asset off which you build your equity market valuation. You need a risk premium to buy into equities because they are riskier than bonds. So yeah, you could get 5.5% on short-dated government debt in the States, or in a money market fund, or you can get a 5% yield on the S&P 500. So the relative attractiveness of bonds is increased relative to equities quite meaningfully. In fact, we have a sort of fancy model that pitches the two against each other and looks at some relative risk terms and things like that. And that's generating a very rare sell signal. The first one in really since pre-GFC. So it's a very different environment for equities versus bonds compared to the last 15 years, really.
I think that's an excellent closing remark. We're in for a rough ride, likely, for the second half when it comes to equities.
It looks tougher, exactly. It definitely looks tougher, at least the next few months. But maybe this whole second half. I think we have to see how the macro evolves from here.
Yeah. Thank you very much, Chris. Looking forward to update on these views in a couple of weeks.
Brilliant. Thanks, Stefan. All the best. Take care.
All the best. Take care.